Hi girls, we're starting our next topic, which is investing in shares. And you'll need this new book. First of all, let's talk about some of the terminology that you might hear in this unit. So a share. What's a share? Well, a share is a unit of ownership in a company. So for example, if you had a department store, the department store has some property, it has a whole lot of stock, it has some staff, it has a whole lot of money associated with the wealth of that company. And if you're a shareholder, you have a portion of that wealth. So a share is a unit of ownership in that company. You have a say in what happens to that company. Okay, so why do people invest in the share market? Well, it's a really good way to make your money work harder, to make money, but it's also a really good way to lose money. So it's a bit of a gamble. What's the share market? Well, the share market is also called a stock exchange, and it's a marketplace in which shares of companies are bought and sold. You could think of a share market as like a department store for shares, where you can buy, sell shares. And there's lots of different share markets all over the world. So you've probably heard about the New York Stock Exchange and the London Stock Exchange. And we've got one here in Australia called the Australian Securities Exchange, or the ASX. Now in Australia, our ASX does two things. It operates as a primary market, which allows companies to raise money. And the way they do that is a company issues a share, which is, think about like a piece of paper. It's not a piece of paper, but think about like that. They issue a share, an investor gives money. So an investor then has the share and the company has the money. And it also operates a secondary market in which investors can trade between themselves and sell the shares at prices which are determined between the investors. And obviously you want to sell your share for more than you bought it, because that means you're making money. All right, so what are shares? Well, we talked about that, but let's do it again. So a share is a portion of ownership that you have in a company. Yeah. The value of your share depends on several factors. Okay, so it depends on how much the company's earning, its future growth, industry trends, economic climate. But ultimately, the value of a share depends on how much somebody's going to pay for it. So if no one will buy your share, that's worthless. You have no money. Even if you paid $100 for a share, it's absolutely worthless if no one else will buy it. What's a shareholder? Well, a shareholder is you if you buy a share. You own a percentage of that company. How do you buy or sell shares? You can do it two ways. You can buy from the company itself when the company is first entering the stock market. That's called a public float. Or you can do that after the company's on the share market, and you can buy from other investors. Now, how does a shareholder make money? Well, there's two ways. The first way is by trading the shares. So you buy some shares from someone else and then you sell your shares for someone else and try and make money that way. And the second is by receiving what's called dividends. And dividends are bits of profit that the company issues periodically. So a company's doing really well and it issues some profit and the shareholders get a share of that. Okay. So out here, this diagram at the top just explains that a little bit visually. So we've got the company, the investor, stockholder can earn in two different ways: stocks trading and the company's dividends. Okay, what picture I've got here is of a share table. Now, you can go online and have a look at this, and I really encourage you to do that, at the information available to someone who's considering going into the stock market or who's monitoring their shares. We've heard of stockbrokers. Stockbrokers, it's their job to monitor the shares and advise their clients on what money they should be making, what shares they should be trading. So have a look at that, and then I'm going to get you to do exercise 4A, which just has a couple of questions there. Okay, we're going to look at this concept of price to earnings ratio, P/E. You might have seen this if you looked at the share table or if you did some research online. P to E, price to earnings ratio, is a really common concept when you're looking at shares. So the price to earnings ratio is a valuation of a company's current share price compared to its earnings per share. So let's just say that again. A company's current share price, so that means what it's worth now, compared to its earnings per share. Okay, so let's just talk one thing. How do we work out its current share price? The share price is what's called listed on the ASX. So it's officially listed on the share tables of the ASX, and it's all digital now. So that's an official share price. So a price per share compared to its earnings per share. So the amount of earnings that the company's making per share. Okay. So the P to E ratio states the value of a share relative to the wealth each share in the company is creating. It's a way of working out how expensive a company's shares are. You end up with a figure that represents the amount of money you are paying for each dollar of its earnings. Okay, so it's kind of a helpful concept because it helps us work out whether we're getting a good value for our shares. So we take our share price, which is here, and we divide it by our earnings per share. Now, these formula might be alarming you at the moment. Remember, you have a summary sheet for your test. All right, the earnings per share are the previous year's net profit divided by the ordinary shares. Here we go here. Earnings per share. Net profit for ordinary shareholders divided by the number of ordinary shares. Okay, so what does all that mean? Once we've got those calculations, we're going to get a number. And the number's going to fit onto this table. And it's going to tell us whether the company is undervalued, whether it's reasonable value, if it's overvalued, if it's exceptionally good growth. And based on that, a lot of people make a choice on whether to invest in that company. Let's do a question, and it might fit, make it a little bit clearer in your minds. 16 would be reasonable value. Okay, so we have HWB Industries reporting a net profit of $36.5 million for ordinary shareholders. It has 73 million ordinary shares on issue. Calculate the P to E ratio if the share price is $8. Okay, so I've got it over here, P to E ratio. I need the share price, which I've got, and I need the earnings per share, which I don't have, but I've got a formula for it. So let's do that. So earnings per share equals the profit of the shareholders over the number of shares. Okay, so 36.5 million I get enough zeros? Yep. Over 73 million. And I get 50 cents. Okay. Now my price share price is going to be 8 over my earnings per share, which I just worked out here. And I get 16, not dollars. Let me just rub that out. The answer is 16. Okay, if you had a look back at the table. Okay, let's do B. The share price moves up to $12. Calculate the new PE ratio. Okay, so the 8 is gone and we've got 12 over 0.5, which is going to make us 24. And then C, we've got a scandal and we're down to 5. And we get 10. What is the effect? Okay, 16, 24, 10. So you can see that the circumstances really affect the price to equity ratio. Okay, let's do this one down here. You have a go, and then I'll have a go, and we'll see if we get the right answer. Okay, did you get the same as me? Can you now do these exercises here? It's really important that you understand, so if you don't, let me know and I'll go through it again.